If you're looking to buy Hyliion stock, then keep watching this video because we're going to look at the company's recent news, the market treatment and the reaction to the company, and what are the technicals telling us. We're also going to try to come up with the best trading approach given the current circumstances. As the market remains very volatile, we should always be careful about which positions to pick up, as well as the individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Hyliion share price has been trending around 56 cents, down by almost 9% over the past week, and more than 75% since the beginning of this year. Hyliion has been having a relative lackluster price action over the course of 2023, but in the recent days the downward spiral suddenly accelerated. It's really important to understand why this has happened and what does it mean for what's next. Recently, Hyliion announced that they are going to shift their focus from putting out powertrains to manufacturing and promoting their add-on products. While this may be a sound plan and choice on paper from a pragmatic perspective, the market is not where everyone is a rational being, where we look at all the angles from almost like an accounting perspective. It is a place where our collective desires get expressed and where the prediction of the future is much more a projection than the product of our rationality. So our money follows our emotions rather than the objective facts. And in the case of Hyliion, the company wants to switch gear and to start servicing existing vehicles. For most participants in the EV market, the combustion engines are going to be a relic of the past, and they will not be replaced. The reality is giving them at least half the points, with a significant uptick in the electric vehicle ownership and offers over the past few years. It doesn't mean that the adoption is going to be very smooth, and no one promised that it has to be. Nevertheless, by announcing that they will stop committing capital in developing new powertrains, Hyliion has changed its own corporate outlook. At the same time, it tries to admit that their cash flow is tight. Those pieces of information are all but well received, and we have seen the consequences on the price action thus far. Now, here's what the technicals are telling us. The trading volume of Hyliion is around 902,000 shares versus the average volume of 3.7 million shares. Over the previous 52 weeks period, the price fluctuated between 52 cents and $3.58. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there is enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Hyliion is currently $107 million versus the enterprise value of $188 million. As we compare the current price to the historical price fluctuations, the stock is 15% higher than the 1-month low, 15% higher than the 3-month low, and 15% higher than the 52 weeks low. On the options market, which gives us a hint on the market sentiment about where the stock price is probably going to go next, the implied volatility is 191% versus the historical volatility of 190%. The put-call volume ratio is currently at 7%, and it's normal for most stocks to have a higher put option volume than what it deserves, as many institutional investors hedge their long positions by buying out put options. The most recent volume of options traded is 45 contracts a day, versus the 30-day average of 542 contracts. In terms of open interest, the most recent volume of open interest is 39,000 contracts versus the 30-day average of 40,000 contracts. In terms of the shareholder structure, institutional shareholders own 30% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and iShares. Typically, it's always good to see some institutional participation when holding a stock long-term, as it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is just 9% of the total float, 51% of which from the dark pools. In other words, we're unlikely to see any sort of significant shorting operations going on, and that we're probably not going to see any sort of short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience and the diverse sectors, may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. My recommendation for Hyliion is to stand aside for the time being, wait for the prices to stabilize first, and then reevaluate whether Hyliion is a stock good for you. I would recommend to commit between 1 to 3% of your portfolio in Hyliion as a long-term holding potential target. And I would also recommend to split the allocation in batches of 10 to 20% at a time over 3 to 6 months, so that you may purchase more in case it goes lower.